If you turn on financial television today, you're greeted with a wall of flashing numbers, scrolling tickers, and shouting analysts. The modern stock market looks like an impenetrable maze of chaos. But these mechanics trace back to the 1600s, when the Dutch East India Company managed massive fleets cutting through treacherous global waters. The company was moving highly valuable commodities, spices, gold, and silk across the globe. Operating at that scale was incredibly expensive, and funding these multi-year voyages completely depleted the company's own capital. To solve this cash flow problem, the company's directors visited local coffeehouses and shipping ports, pitching their trade routes to private citizens who could provide the necessary funds up front. Those individuals handed over their own money to support the voyages, and in return they received a legal guarantee of a percentage of the ship's eventual profits when the spices were sold. By inviting the public to shoulder the financial risk of trading expeditions, the Dutch East India Company quietly created the very first stock market. We can see exactly how this works today by imagining a successful local coffee roaster that wants to build 20 new locations but lacks the cash to do it. The roaster will first approach large institutional investors and banks, presenting their expansion plans and financial history to secure initial backing. Once those institutional investors agree to sponsor the expansion, the business schedules an initial public offering, or IPO. This is the exact calendar date when a privately owned business is officially listed on the public market. On the morning of the IPO, any individual or institution who thinks the coffee company will turn a profit can log into a brokerage account and purchase a stock. Buying that stock means acquiring a fractional slice of the business itself. Every share purchased makes the buyer a legal, partial owner of the coffee company. 4 centuries later, the transaction is identical. Individuals provide upfront capital to fuel corporate expansion, and they do it to secure a right to the company's future success. With the cash generated from the IPO, our coffee company successfully builds its new locations, hires more staff, and significantly increases its quarterly profits. As these strong earnings reports go public, outside observers take notice. They see a thriving business and decide they want to capture a share of those profits for themselves. Look at this graph showing buyer volume versus share price. As a larger pool of investors tries to buy a limited number of shares, that intense demand directly drives the price of the stock upward. This rising price tag instantly benefits the original buyers. The shares they purchased during the IPO are now worth significantly more on the open market than what they initially paid. The business also reaps the rewards. A high stock price inflates the company's total market value, giving executives the financial leverage to secure larger loans and fund even more ambitious projects. Under perfect conditions, the stock market operates as a straightforward mathematical engine, where public demand precisely tracks with a company's tangible, physical success. But perfect conditions rarely last. Eventually, a business will miss an earnings target, face a supply chain delay, or simply begin to look less profitable on paper. Companies are constantly subjected to unavoidable external forces. An unexpected spike in the cost of raw materials, the sudden emergence of a rival technology, or necessary shifts in labor rates can instantly shrink profit margins. When margins shrink, investors get nervous. Anticipating a drop in the stock's value, they quickly sell their shares to lock in their existing profits before the situation worsens. This chart illustrates the immediate fallout. A mass sell-off evaporates demand, causing the stock's price and the company's total market value to crash in tandem. This constant, aggressive seesawing between supply and demand generates the volatile daily noise we see on financial networks, proving that stock prices are highly vulnerable to uncontrollable external pressures. Because of this vulnerability, a company doesn't even need to actually lose money to suffer a crash. Simply appearing as though it might lose value is enough to spook shareholders, triggering a self-fulfilling cycle where panic selling creates an actual loss in market value. That panic is often driven by highly subjective variables. A sudden change in a CEO, a wave of bad press, or vague anxieties about trade policies can motivate thousands of people to dump their shares simultaneously. The stock market functions as a massive, real-time tracker of collective human psychology. It measures human confidence, and those daily emotional swings possess enough leverage to trigger huge economic booms or deep financial crises. For centuries, managing these emotional swings was the exclusive domain of institutional brokers. But the widespread adoption of the internet decentralized the system, giving everyday people the exact same tools to buy and sell stocks as the major Wall Street firms. Because predicting the daily anxieties of millions of human beings is impossible, the most effective strategy for an individual is to ignore the daily noise. By choosing reliable, long-term investments in businesses you genuinely believe in, you can bypass the panic and build actual financial stability.